I'm Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services, and I'm with you for another monthly update to the market and economy. And let's jump in. Friday, December 16, 2022. Let's talk about some of the developments over the past 30 days. I'll have a few talking points here, and then I'll expand over them in a minute. First of all, inflation. We got a very important inflation report this week. The Consumer Price Index, which is probably the most widely used measure of retail price inflation in this country, decelerated again. It slowed again to a 7.1% annualized rate in November, and that's down from a peak last June of 9%. So this is a pretty convincing downtrend so far that we have in inflation, which is great news, right? Because we all know that the Federal Reserve's fight against inflation is what is causing the economy to slow. So the quicker we get back to normal, the better. Now, there are pieces of inflation that are not really cooperating as much right now. Shelter, for instance, like rent, rising at a 7.1% rate versus 6.9 in the prior month, and so that number's, at least right now, moving the wrong way. And average hourly earnings, or just in general wage growth, 5.1% is ticking up from the prior month. And you know, it is true that rent and wages are coming down, but they're just not coming down very quickly. So we find ourselves in a situation where increasingly investors in the Fed are in an argument about the pace of normalization for inflation. So how quickly is this happening? And I know plenty of really smart investors who are saying that the Fed is maybe not as aware as it needs to be of the fact that on the ground most prices are falling and fairly quickly. This argument, by the way, about how fast inflation is falling, kind of spilling over into interest rates, and I'll talk to you in a minute about what I mean there. The Fed's point of view is that rates are rising above 5% probably over the next several months. Going to raise their Fed funds rate's going to go from 4.5% to over 5%, and it's going to stay there during most of 2023 in order to get inflation down. Investors absolutely disagree, and we can see this not just in interviews with professional investors, but we can also see this through the bond market pretty closely, and I'll show you that. Anyway, investment community's view is that rates are probably going to peak at 4.9% this spring. This is the Fed funds rate, and probably fall off thereafter. So that, I realize the numbers aren't that far away, right? But there's a big gap here, and the gap has to do with that last phrase, fall off afterward, and because what causes interest rates to fall? Typically, the Fed will take interest rates down when the economy is really faltering, when it's really having a hard time. So that's what investors are saying. They're saying, hey, Fed, you've probably done enough already. You need to calm this down, or you're really going to drive the economy into recession. That's the Cliff Notes version here. Meantime, economic growth, core economic strength is pretty resilient, and it's making the Fed's job harder, which means it's kind of prolonging this process that I've talked to you about before, the process of normalizing the entire economy and financial markets after so much crazy up and down, so much distortion, really, from COVID. The Fed's view here is that, okay, the economy's still pretty resilient, but we'll knock it down to stall speed in order to get inflation down if we have to. All right, so all that said, why are we even having a rally? So that's what we'll talk about today. Okay, I wanted to group some prices in the economy by prices that are going up and prices that are coming down. So on the left-hand side, here's prices coming down. It's green because it's a good thing at this point. We can't have inflation, rising at 7% forever. That'd be a bad scene for us. So topping the list here is a gallon of gas. This is the national average reported by Bloomberg, and it's down 4% over the last year. That's great. Like we had Russia's invasion of Ukraine, and we were hearing at that time back in March that oil prices would probably rise to 150, maybe $200 a barrel. None of that ever happened, right? So gallon of gas is coming down. Cost of shipping a 40-foot container from Shanghai to LA is now down 80% from a year ago. And what that means is the supply chain problems that we had during and post-COVID are really cleaning up. Used vehicles prices are coming down, now down 3.3%, and that chart is headed lower. Major appliances down 1%, televisions down 17%. I guess we got all that we needed. We bought all that we needed during COVID of all that stuff, and now demand is falling off. On the other side, rising prices, healthcare insurance. No surprise that prices are going up there, but 13.5%. Restaurant meals, 8.5%. Auto repairs, 15%, and airfare, 36%. Finally, dry cleaning, 7.9%. So, by the way, I want to make 2 points about this slide, then we'll move on. First is that if there wasn't strong demand for auto repair, airfare, dry cleaning, and restaurant meals, those prices would not be going up. Okay, so that's kind of a signal of strength in the economy. Second, the left-hand side of this chart really speaks more to goods, like manufactured goods, whereas the right-hand side of the chart really speaks more to services. And I'll make that point a little finer as we move on here. Okay, more on the path of inflation. And I mentioned before that investors in the Fed really are not seeing eye to eye right now. And so I want to use this chart as an example of what I mean. A big part of CPI, that consumer price index, like 20 to 25% of that is composed of what they call tenants' rent and owners' equivalent rent. It's just housing costs. And what they do is they say, well, you know, how fast are rental prices rising? And then let's assume all the people who own their own homes are actually renting them. What would that look like? Which is silly, right? That's silly, but they do it anyway. Anyway, that's 20 to 25% of CPI. And what I'm going to show you is that the methodology behind how they calculate this is really faulty. So that's the blue line here. And you can see that it did rise quite a bit during 2021. And now it's hooked down just a little bit. That's the blue line. On the other hand, let's take a look at Zillow's rent index. And this doesn't do any of the kooky stuff, like assuming that homeowners have to pay rent. It's just looking at new rentals. Okay, so there's a lot of more volatility in that gold line, Zillow's line. You see a massive run up after COVID, but an equally large crash in rental rates after that. And so I guess what I'm saying is the blue line, the CPI, the government numbers for inflation are they're masking reality, and they're not showing you the degree to which rents are really falling. This gold line, by the way, what it's portraying is the monthly change, percent change in rates. And so you can see that rates are barely rising right now by 0.25% per month. And again, this line is headed down, lower. It likely will not arrest itself here. And so, investors are looking at this saying, look, CPI isn't the end-all be-all, and the Fed recognizes that. But I think the interpretation of where we're going in 2023 is very different. The Fed says, I don't trust it. This economy is too strong, and it will likely be very tough to get services inflation down. Whereas, most investors are saying, well, we're extrapolating a much bigger dip in inflation because you've already raised interest rates by quite a bit, by 4.5% in the span of 9 months, and probably should stop this and wait to see what happens because of the known policy lag. Okay, so that's the nexus of the argument between investors and the Fed, and I believe they're splitting on a number of issues, but this is a big one. And this is how this is evidence of that split. The orange line is the federal funds interest rate, and this interest rate is set by the Fed. That's why it goes up in like a nice stair-step chart. And the Fed just raised interest rates this week again by 0.5%. But normally the 2-year Treasury yield, which is the bond market, that's investors trading based on the economy and where interest rates or Fed interest rates are and everything. So the 2-year Treasury is generally following as the Fed funds rate has stepped up. But over the last month plus, interest rates have been falling. They're not really following that stair step up anymore. And this tells you that investors are expecting the end of the interest rate cycle pretty soon. That's not what Fed Chair Powell is saying. He's saying that, yeah, we'll get to a terminal rate pretty soon. And that terminal rate's probably going to be over 5%, and then we'll hold it there to restrain growth in the economy for a time, like most of 2023. Now, bond market's not buying it. 2-year yield is falling. In fact, yields all across the maturity spectrum are falling. So what investors are saying here is that you'll never get to 5.1. In fact, probably rates have peaked for this cycle already. Okay, and why is this important? This is really important because if the Fed keeps restraining the economy, and they're restraining in a number of ways. I say, rate hikes is a big one I point to, because when you raise the cost of borrowing, fewer people are going to want to buy a car or a home or take out a business loan. Okay, but they have other tools that they're using too, and so they're trying to restrain the economy. And remember, like if you attended one of our client appreciation events, it's really 2023 is all about the landing. Can the Fed engineer a soft landing where the economy does not enter recession, where they're able to knock down inflation to an acceptable level and an acceptable downward trend, so that they feel okay about stopping the rate hikes, letting the economy breathe? Or do we have a bumpy landing full of more volatility like we saw last year in stock and bond markets, and we have slowing the economy? Doesn't necessarily mean a recession, but you're really anemic growth for a while. That, as I said during the client appreciation event presentations this year, that is what we consider to be the likelihood. And then, or are we going to have a hard landing? Does the Fed blow past all the stop signs and just say, we're going to kill inflation no matter what it does with growth? Anyway, it's our view that we're still in the bumpy landing case. We still expect more volatility this year, coming into the end of the year, and then through at least the first quarter of next year, we see the possibility for some investment risk there as well. Meanwhile, I want to talk to you about the tale of two economies. I said the economy's been pretty resilient, and it has. But I've thrown up a chart here with two lines. The blue line is a survey of business leaders within the manufacturing sector, and they ask questions like, well, how's business now? Current production, is it better or worse than it was last month? How about new orders, export orders? How about hiring activity? Are you slowing hiring, or you still can't find enough employees? And 50 is a key line. 50 is what they define as the line between businesses is expanding or business is contracting, and you can see that this blue line just fell below 50. The last time it fell below 50 was in the middle of this chart, where you see the label that says COVID recession. So manufacturing is clearly slowing, and we saw more data to corroborate that this past week. Thankfully, manufacturing is only about 10% of our economy. And you saw when I showed you, and I'll bring this back, the places where inflation is falling the most, or the places where you actually have deflation, tend to be in commodities and goods, manufactured goods. Okay. Now, by contrast, the orange line is non-manufacturing, so the services sector. This is the area where we're seeing more demand, where the Fed is more worried about perhaps their impotence in bringing inflation down. And this line actually ticked up over the past 30 days. So, and this, 56.5 is the level. It doesn't matter except to say that that level is considered pretty healthy. So the services side of the economy is 90% of the economy, so it outweighs a lot of what's happening in the manufacturing sector. And so that might actually explain why GDP, or gross domestic product, which is a stupid term for economic growth in this country was really anemic. In fact, it was negative in the first half of 22, but it has since reaccelerated. And that doesn't make any sense, right? The narrative is that everything is slowing and we're going to fall off a cliff. Okay, but it is true that GDP is tracking, economic growth is tracking to a much more normal and, in fact, pretty decent level for the second half of this year. And it could be this, it could be the services. So yeah, we see both sides. We see why investors are saying, hey, maybe the Fed should pause. We also understand why the Fed is concerned that maybe there is so much demand in the economy that it'll be tough to get services and inflation under control. Okay, so why the rally? Well, first of all, economic growth is improving. Second, as I said earlier, it looks like, or investors are predicting, that the Federal Reserve's rate cycle, or rate hiking cycle, is close to done. So within the next, say, 4 months or so. So what that means is that there's light at the end of the tunnel, and you got your Santa Claus rally a little bit early. But the market since stock market since mid-October has moved higher, and so has the bond market. Because we're coming to the end of the rate cycle, you got to figure that interest rates don't have to go much further. So it's possible that we've seen the peak in interest rates already, and yet I'm still predicting more volatility because we still haven't solved for this. What's the landing? I think the next couple of CPI prints or reports, the next couple of inflation reports, are going to be crucial in cementing the downward pressure on prices. We can't see tomorrow, but we can extrapolate, and it does look like prices throughout the economy next year will be significantly lower, I think, than they are now. And here's a by the way, a look at the chart that I typically will show you to put what's happening right now into perspective. During this bear market, we've seen a lot of volatility, both down and up, more down than up, but still there's been some rip-roaring rallies, and this one has gone on since October 15. Now, since the Fed announcement, specifically, the market's sold off a little bit, but I think it's really hard to tell in the near term where we're going to go. Because we still need to see those reports on inflation. We still need to see how the Fed is going to treat this rate cycle and how much credence they're going to give to this concern that the services inflation is just stubborn and won't come down all that much. One more thing I need to say too about all of this disagreement between the market and the Fed. Investments are going to go their own way. Okay, so I mean, I think one of the lessons for investors here, especially over the last week in post-Fed meeting, is that the Fed doesn't have a crystal ball. You know, they made some updated economic projections that the GDP was going to be just absolutely flatlined next year. I'm not sure that we can predict that. If we look back a year, I'm told that most of the Fed governors thought a year ago that by now they would have to have their Fed funds rate at 1%. So it's at 4.5. At the beginning of the year, during the first quarter, I heard a lot of really smart investors saying, no, we're going to have a recession in late 2022, and that is just not happening. So I guess what I want to say is that, you know, there's going to be a lot of volatility. The way forward is not all that clear, and I can see both some positives and negatives. Remember, this is a process. We've got to zoom out. And although the media wants us to think about the next 2 weeks, when is the Santa Claus rally going to end? And are we going to be higher on January 1st? I don't know. But I can say that this is a process of normalization from all the distortion brought about by the pandemic and the policy response to the pandemic and all of the stimulus, both by the Fed and Congress, and everything got thrown out of whack. We need to get back to normal, and this could take the balance of 2023 to get right again, to bring inflation back down and wage growth down to more normal numbers relative to economic growth. So stay with us, stand by. There's a lot more positives than you're hearing about in the news media. But I think in the next few months, we're going to experience some more volatility as the Fed shows its hand. So with that, I'll skip to these here and say thank you for watching. Happy holidays. Hope you have a great time with your families, and we'll see you again back here in January. Thank you very much.